Hello, everyone. It's Crispin from Pendle Group with an update on our thoughts on the market. Now, we've been speaking to this being a phase of maximum uncertainty, combination of a lack of clarity on the scale and degree of the health crisis, and the uncertainty around the size and the speed of the policy response. Now, today I'm going to speak to how we see these issues evolving, and I'm going to break it down into four components. First is on the health side. Now, we've seen countries like Italy plateauing in terms of new cases, but at very high levels, and no real signs of these levels letting up. Equally, we've seen in the US an acceleration of cases as testing has been rolled out, and we're getting a sense of the true scale of the virus spread and a clear warning of the consequences of not imposing enough restrictions on activity. In Australia, there has been some early positive signs that measures are helping contain the case numbers, and also importantly, the severity of cases so far have remained relatively low. Now, clearly this can change quickly, but it does have important implications, both for the health outcomes and also the duration and the depth of the economic downturn required to manage the flow of cases through the health system. Second, on the policy front, we have seen good progress in many countries, notably the US, with a government program equivalent to around 10% of GDP. Now in Australia, we have had the government announce their wage support program, which in combination with the already announced measures takes the overall response to over 10% of GDP. These are sizable programs beyond anything we've seen in decades. Now they're critical, not so much for softening the near-term economic blow. That's going to be difficult because people just can't engage in economic activity, but they will enable a longer-term pathway to recovery. If you burden business people with too much debt, that will choke any recovery. So this is a necessary investment by the government in human capital. The wage subsidy is important as it may help contain an even larger uplift in unemployment. Already, we believe that this is likely to spike through 10% and potentially up to 15%. It is also worth highlighting the actions of central banks, notably in the US, which are putting in place measures to normalize funding markets, and these are critical for businesses to stay solvent and retain labor. So we should have some greater confidence that the declaration policymakers around the world have made to do whatever it takes is being fired up, which reduces some of the uncertainty and risks in the market. Third, onto the markets themselves. The greater clarity on policy combined with the end of the initial liquidation phase as various funds cut risk, de-geared, has helped stabilize the market in the near term. The reason we're not yet seeing a more meaningful market recovery is due to the growing recognition of the scale of the downturn in the second quarter, with estimates anywhere from down 10 to 30%, depending on how long these high level of restrictions remain. Earnings implications will also be larger. Again, it's almost impossible to predict right now, but certainly numbers of between 30 and 50% down are possible. Now, it is important to put some perspective on this because I think we need to think of 2020 as one large collective write-down by corporate Australia. And the focus from an investment point of view is whether companies firstly have the capital and the liquidity to ride it out. Can they avoid being too heavily diluted in a capital raising? And whether their businesses will recover relatively quickly, or will they be constrained by the potential ongoing limits to activity? And finally, are they able to materially reduce their long-term costs for what will be a lower level of activity? So it's looking through the near-term issue at how these companies are positioned further out. What we should expect is a lot of capital raisings, and you need to be selective on these. Focus on the key issues, the type of industry, its structure, the company's market position, the quality of the management. And when a company does raise capital, you need to make sure they are telling you the full story. Are they clearly raising enough money to get them through at least 12 months of weak activity as the market will not be forgiving on companies that have to come back for more capital calls. The other issue I want to flag is the risk to dividends. I think this is material and potentially larger than the market expects. It may only be the next dividend or perhaps the next couple, but preserving liquidity and capital will be the priorities for a lot of companies, and particularly for those industries which are also benefiting from government programs. The final perspective is at a company level. Now, I've said before, our focus is not to try and make that heroic call on which way the economy and the market goes, but to take a long-term perspective and build a portfolio that identifies the best companies that meet four objectives. Either they're providing protection in a recession, they're leveraged to policy, they're good businesses facing short-term challenges but coming through that and being stronger, or companies that will give you protection if we've got a very quick solution to this health crisis. I wanted to highlight a couple of different examples. Firstly, Amcor, which provides the packaging for health, food and personal products, all essential items that people need where demand is holding up. Dominant player in their industry, lowest cost player, and very good free cash flow. If things do end up proving to be worse for longer, this is a company that will prove very defensive in the portfolio. Second company highlight is Nine Entertainment. Now, yes, this company is more leveraged to the economic cycle. It will be impacted by a drop in advertising, the loss of the NRL, but it has the benefit as well from improved subscription to their Stan service. And they've also been very proactive and announced cost savings of over $200 million. On top of this, they have a good balance sheet. They are the strongest player in their industry and will be very well placed for any recovery. And we expect them to perform particularly well if we see the policy is seen to be working. So we are in an environment where there is still a lot of uncertainty, but also, given the drop in the market, opportunity. And it's important as investors to stay disciplined, have a clear plan of action, stick to fundamental principles, and identify those companies where the risks are being overly priced into their valuation. At Pendal, we have a team of 17 people in Australian equities. And while they may not be able to go out and physically meet with the companies now, we are engaging in an intense daily program of contact with these companies. We've spoken to well over 100 different companies, some multiple times, to ensure we're getting as much information, as much insight to enable us to make the right investment decisions and position our portfolios in the best possible way for the variety of outcomes and get the best outcomes for our investors. With that, I'd like to thank you again for your time today.